So, hi, good evening, everyone. It's a pleasure to host Vivriti Capital to this webinar. Who is the company is coming up with a maiden public issue, debt public issue. And in the interest of the people who have already attended Path, I think we should start. We are seeing a good motivation. People are still continue to join in, but in the interest of the people who have already joined in and for their time, we can begin with the webinar. Let me introduce Mr. Parth Sanghani, who is a treasury head with Vivriti Capital and who was earlier the founder and CEO of MakeMyEMI.com. He carries a huge work experience of more than 15 years in the industry. He has worked with reputed names like Deutsche Bank, Infosys, and many more. In the Kotak Mahindra Bank also, he was associated with. It's a pleasure, Parth, to have you in this webinar where a lot of retail investors have joined in to seek an understanding about the business model of Vivriti. What is the offering that Vivriti is doing in the upcoming public issue? So I leave the forum to you to take us through. In a way, we would like it to be more interactive path. So we'll probably have quick introduction, and in between we can probably take some question and answers and probably some points which we mutually believe should be further highlighted for the understanding of the rest of the attendees. So I leave the forum to you, Path.
Sure. So, am I audible?
Yes, very well.
Okay. So, just put my phones on silent. Yeah. Right. So I'll do this in a three phase. One is I'll present the company in brief, present the structure in brief, and the last part we can keep for Q&A. Right. So let's break it down in three stages. That works?
Yeah, yes, that's better work. In case we need some points to be highlighted, I will take your permission to stop you and further give explanation to the people because these are general retail people who and the investors, along with some of the family offices, may have joined the webinar.
Sure, sure.
But everybody would like to have as much insight in Vivriti's model as possible.
I'm unable to host to share screen.
Okay,
Like present a deck.
just a moment. Let me work it around. But I've sent you on the WhatsApp. If you would send it to me, I can put it on the share screen mode.
I'm not sure if I'll be able to send the deck on WhatsApp.
Path, I have given you the hosting rights. I think now you can share the screen, right?
Let me try. Yeah. Now
Okay.
Great. So thank you, Nagesh, for the introduction, and thank you everyone for making time to come for this presentation and this session. I'll just take you briefly with the company's headline number first. So we are a little over 5,800 crores of AUM, with capitalized with 1,500 odd crores of 1,500 plus crores of equity and roughly 4,700 odd crores of debt. We have been profitable since day one. Last year, we clocked a profit of close to 130 crores, generating a return on equity just about touching the double digit. Our liability franchise is vast. We are funded by over 200 institutional investors. Over and above that, we have close to 1,700 odd HNI investors in our privately placed bonds as well. This issue, as well as the company, are rated by two rating agencies. CARE has a stable stable outlook with a positive with an A rating. CARE has a positive outlook on the company with an A rating. And we are very well capitalized with capital adequacy ratio of over 25% against the regulatory minimum of 15%. One of the most important parameters for any finance company is the gross NPA number. So this is just a shade more than 30 basis points, and this is without any restructured assets on the balance sheet. We have never, since the inception of the company, we have never restructured any kind of loans. So what you are looking in the gross NPA number is pure performance of the asset book of the company. Taking you briefly through the group structure. So Vivriti Capital is the non-banking finance company. It holds Vivriti Asset Management Company, a stake in Vivriti Asset Management Company, and a stake in Credavenue Private Limited, which is now called UB. Very brief journey of the last 6 years since we started the company in January 2017. We got the lending license from RBI in 2018, and creation investments invested close to 300 crores in 2019. This was a Series A round. Shortly after that, in 2020, we got an A minus rating from ICRA, one of the very few NBFCs to get an A category rating in the very early stages of its inception. In 2020, Lightrock came with Lightrock and Creation combined infused another 450 crores of capital. In 2021, we were rated A by CARE, and post that we crossed 5,000 crores of AUM. In 22, we launched our first sustainability report presenting ourselves as a company which does responsible lending. In 2022, TVS Capital infused to 220 crores, and Lightrock and Creation repeated their investment, taking the total investment to close to 650 crores. In 2023, we converted from a private limited company to a public limited company, and so we are a very transparent company now. Have always been, but with being public limited, we are practically our disclosures are probably close to any company which is in the listed space.
Parth, let me ask you something in this stage. You mentioned a lot of investors who have participated in the equity structure of Vivriti.
Yeah.
Can you highlight the journey in which period these equity investments has come in, and what is a major reason for a retail person to understand what confidence does it give when this equity keep coming into the capital structure of any company?
See, capital is the rock kind of reserve as a protection against any kind of a loss that the company might in any eventuality take. Right, that is the protection of the investor. So if I'm borrowing money tomorrow, which is why RBI says that you need to have a capital adequacy ratio of 15%. It means that 15% of your roughly, not exactly by math, but roughly 15% of your total money should be capital, and the balance should be debt. Right? There is only so much that you can borrow, and that limits are put in place so that the investors or the lenders or the participants in any kind of a debt instrument of that company are protected by capital by way of a buffer, right? So that the company does not default. For any company to grow, raising money is raw material for a lending company, right? So it is extremely important to have marquee investors with deep pockets who come as a very responsible board member, right, to guide the company and to continue to invest in the company, which gives a lot of confidence to the investors, right? So this is to fund growth, and probably equity basically is a buffer towards future losses. So our buffers are, so to speak, instead of 15, I have 25. So to speak, it gives a lot more buffer than what the regulatory minimum is.
So if I
Right?
have to understand from a retail perspective, 100 rupees that is lent by Vivriti, 25 is their own skin in the game?
Yes. Yes.
Okay.
And roughly 75 is borrowed, but that is not how capital adequacy ratios are calculated. It is calculated based on risk weights, but very basic basic understanding is that out of the 100 rupees that I have lent, roughly 25 is company's money and 75 is the lender's money or the
Great.
investor's money.
So if you could also highlight some of the investors' name that you have taken, are these investors coming in a regular interval or they were the seed capital in the Vivriti business model?
Right. So Creation has been investing in India for more than 10 years now. Right. So they understand the Indian landscape very, very well. They come with extremely deep pockets. Lightrock is Europe's largest private wealth fund. Right. They understand India very well. These investors have the ability to guide the company through a very high growth phase. Right. TVS is a and Sri Rajagopalan is very, very well-known name in the industry, and TVS Capital is his fund, which is the TVS Group, one of the TVS Group, this thing. When I come to the board of directors, I'll also give you the profile of the kind of directors that we have. Extremely well-known, extremely experienced kind of a director set that we have, and having a diverse set of equity investors in the company it gives a lot of credibility and confidence to the markets that there is very, very, very professional category of investors who are backing this company, and a very professional pedigree of board which is backing this company.
Okay, Path, I request you to continue with the flow. We'll probably keep on having these interaction on
Yes,
little
please.
break.
Yeah, yeah. Feel free. Feel free. So touching on the business model, very we are a specialist in the mid market space. Mid market is a medium sized company, right? We lend to companies who have a turnover of, let's say, upwards of 50 crores, going as high as probably 2-3,000 crores, right? So this is a very specialized lending. We are a specialist in this space. So typically you will see finance companies doing personal loan, home loan, car loan, two-wheeler loan, micro SME loan, microfinance loan. We are a slightly different company in that sense, where we specialize in lending to mid-sized corporates, right? And this is diversified across sectors: healthcare, pharma, logistics, mining, infra, trading, retail, auto, manufacturing. We do EV financing, right? So we are a slightly different kind of a specialist, and very handful of companies who specialize in our country in this space. So we have close to 200 odd mid corporates to whom we lend, and we also lend to another 200 odd vendors and dealers of these corporates as working capital to fund their working capital requirements. We have offices in Tamil Nadu, Madras, Tamil Nadu. We are based out of Chennai. We are headquartered in Chennai. We have offices in Maharashtra, Karnataka, Rajasthan, and Delhi as well. We have a book we also have a retail book, which is spread across 8 asset classes, which is originated through co-lending model. And co-lending is the digital lending guidelines that RBI had recently come up with, right? So that is.
I think your screen is stuck into one particular slide. Are you like you going through the presentation or is it the
This
same
is
screen?
you are at the business segment, right?
No, sir. So it's only the corporate structure which is put up on the screen. You're on mute, Path.
Okay, so the screen was not visible when I took you through the milestones. Which year capital
Only the
raise, rate?
corporate structure screen is stuck. I think probably you have to
Okay, let
stop
me
and share it again.
stop sharing and start sharing again. Key milestones and highlights. Are we on that slide?
I think it's still not there. To me, the screen is coming entirely blank. Let me check on the other side. Just give me a moment. Till the time you can probably go through any, probably take the audience through. Let me check it offline. Okay, now it's visible. Now it's okay. Thanks. Go on, Parth.
So this is the when we got incorporated, capital round, rating. This is what I covered: TVS Capital creation, Lightrock conversion from private to public. This was the conversation that I was referring to. Then we are in the business segment model slide. Is it visible?
Yes, it's visible.
Okay, so this is what I was referring to, that we have close to 200 odd corporate land borrowers, and we fund another 200 odd vendors and dealers of these corporates as well. We have five offices in 5 states. We are based in headquartered in Chennai. We do supply chain finance as well, and there is some bit of assets on the balance sheet, very retail assets, which we have originated through co-lending model. This is the digital lending guidelines that RBI had come out with. Right. So we have a very diverse product suite also to cater to a slightly varied kind of borrower segment that we have. So from ranging from working capital demand loan, working capital term loan, we supply liquidity by way of securitization, direct assignment as well. I mentioned we fund 200 vendors and dealers. So this is the supply chain business, right? There is some bit of CPs also that we do. So average ticket size are of roughly 3.5 crores. We lend in the tenor range of minimum 1 month to the outer limit of roughly 48 months. The average tenor of the asset book is around 24 months, and that is monthly amortizing. So the duration is slightly even lower, close to 12, 13 odd months.
I think, Parth, this is the right time to take one of the questions that's one of the attendee has asked.
Sure.
Is of the total AUM, how much percentage is unsecured?
So supply chain, which is let's say 5 odd percent plus, okay, less than 10% is unsecured. So when we lend, the security, it's a pool of security. We have charge on receivables, inventory, some bit of hard collateral, cash, escrow account. Escrow accounts is rights on the cash flow of the business. So it's a pool of security. Sometimes it is pledge of shares, corporate guarantee, promoters personal guarantee. So it's a pool of this thing. Supply chain finance is a 90-day book, so it's difficult to create. So if it is difficult to create security for such a short product, so roughly less than 10, probably 10, less than 10% of the balance sheet could be unsecured.
Oh, that's a really good model. That 90% is going into the secured is
Secured, yes.
something investor would really appreciate.
Yes.
Okay, go ahead, Parth.
So this is the yield. Yield is the average lending rate that we lend at. Cost of fund is the rate at which we borrow. You will see that our margins have only expanded from 2000 FY21. Especially, you will see that cost of fund has increased from 10.29 to 10.53. That is a 0.24% increase. And this is in a financial year where repo rate increased by more than 200 basis, right? So when the markets moved by more than 200 basis, our cost of fund increased only by 24 basis, and that too we were able to pass on to a large extent. So in a rising interest rate environment, our cost of fund has been extremely under control, very marginal increase, and on the floating rate assets also we were able to pass on the rates to the lender. So the the spread on the loan has increased in a rising interest rate environment.
So, Parth, was it a standard for the entire industry or something that Vivriti is able to achieve
So
for
what
the
has
product?
helped? What has helped us swimming, upstream, is that we got capital infusion early last year, right? Around May, I think TVS came, Series C capital infusion came. Around June, I think, if I'm not mistaken, around June, ICRA upgraded from A minus to A, right? And our gross NPA number, without any restructuring, etc., were probably among the best in class in the industry, right? At 0.3%. So that gave lenders a lot of confidence to lend to us at rates which are appropriate to the strength of the balance sheet, right? And therefore, the increase in cost of fund has been extremely controlled.
And coming to the topic of NPA, which is a non-performing asset, how are you able to manage such a low level of 0.3%? If I've heard it correct, 0.3%, I think it would be among the best in the industry.
Yes, thank you. So we run a so there are so there is a very it's all about process, right? It's all about process. So we have a very dedicated credit and risk team, a dedicated origination team, and a very clearly defined underwriting process, right? So in that sense, origination is done by the business team, and then the assessment, which is desk as well as the client on-site visit, right? So that is done by the credit and risk team jointly, right? The business team has no powers in the credit committee. Credit committee comprises of MD, CFO, CRO, and CCO, right? So the interests are that ways managed very well. Alignment is very clear. Responsibilities are very demarcated, right? There are and we give money only to grow the business, right? We do not give money to a particular promoter where the money is going out of the company, right? So we typically give a running company which has established its model. It is generating cash flow. It has a track record of sales, distribution, etc., depending on model to model. And companies with a track record is where we are lending for the same company to grow that business. So probably he's got 3 factories. We can fund to give money for the fourth factory. So we underwrite execution risk, but we don't underwrite model risk. So if you are in a tire business today and tomorrow you want to do something in sugarcane, probably we will not fund you, right? So we are okay to underwrite execution risk going by your track record, etc. And then we tighten it up with covenants, conditions, and the security package. But we give money to the companies only for growth, no other purpose.
Well, that's a beautiful way to answer that you're participating in the growth story of
Growth
Indian
story of the
corporate
company, correct.
and not, if I have to put it correctly, not on the
Special purpose end users is not something that we do.
That's great.
That's
Acha,
not
there's
something.
one more question. I think one concept that you have highlighted was about the co-lending. Somebody has asked, obviously, what are the current tie-ups of Vivriti's co-lending there, and what are the pipeline, and what is the overall strategy about Vivriti's group in taking a co-lending model ahead?
See, co-lending, now with couple of guidelines and with the recent circular in place, I think the space is very clear about how to operate the co-lending, operate under the co-lending business. There are no regulatory hangups anymore. Both the participants, the originator and the liquidity provider, in this case, we are the liquidity provider. It could be 80, 20, 90, 10, 100, 0. Right? But the participants and the players in this industry are very clear about what the regulations are and the way to operate. Right? So this is going to be regulatory clarity, I think, is the single biggest has given the single biggest boost to this line of business. Right? We probably have we have today more than 30 partners. We probably have more than 30 partners, and we'll continue to add more. We are very bullish about this segment. That will be an important part of our growth strategy.
So, for the interest of all the attendees who are there, let me also introduce Mr. Vineet Sukumar. We have a pleasure of him joining us. Vineet Sukumar is the founder and the managing director of Vivriti Capital, carries experience of more than 2 decades in the industry. He is pioneer in setting up this mid-segment lending model and has been an absolute example of, have shown an example of entrepreneurship in the NBFC segment. So, Vineet, welcome to the webinar, and probably would pause here for a couple of minutes for you to take through the company as you see it from a promoter's eye.
Thank you, Nagesh, and very glad to be here on this webinar. It's quite a momentous occasion for us, and we thank the Tipsons team for organizing this. We see a very exciting future for us over the next few years, because not only are we seeing significant structural changes in the Indian market, be it in terms of infrastructure, renewable energy, power sector, fertilizer sector, chemical sector, electronics manufacturing, solar, electric vehicles, and a host of other areas. We ourselves are also well poised. Today, we remain one of the very, very, very few specialists in mid-corporate finance in a market where the need for the kind of business that we do is very, very high. Today, most NBFCs that you know in the country focus on retail in some form or shape, be it auto, home loans, MSME, microfinance, consumer, etc. We are a mid-corporate focused player. Thirdly, our fundamentals put us in a good, strong position to take advantage of this current situation with a capital adequacy above 25%, gross NPA below at 0.3% average for the last 3 years, and a strong profit track record. We remain in a good position to take advantage. Fourth, India is shining globally, which means that liabilities will be easier to gather, coming in from both the international market as well as domestic market, and India's growth trajectory continues to be strong, which gives us a lot of confidence about the future. Right. Fifth, we are coming out of a cycle which was partly on account of COVID and partly on account of the inflation that followed. And I think now the corporate trajectory is strong. There seems to be a decent amount of capex revival even in the private sector, which was missing for a long time, and that puts us in a good structurally strong position, right? All put together, therefore, I remain positive and confident. I think our fundamentals are good, and I think we have a significant way to go in our growth trajectory.
That's awesomely explained, Vineet. For the sake of all the attendees, this is a standard question that everybody asks, especially to the founder and the promoters. What was the seed idea basis on which you developed this entire story of Vivriti Capital, which was one core reason that you took this step and probably make it one of the largest in the mid-sector lending?
I think what we realized back in the day in 2017 was that the mid-corporate space was really crying for attention, right? Even today, India has a 600 billion corporate bond market, right? And if you look at the last year's numbers, I think less than 5% was picked up, was on account of issuances from single A, triple B, and unrated borrowers or issuers, right? So 95 to 96% was AA and AAA.
Correct.
Right? The skew was so high, right? And it was evident in other parts of the ecosystem, which is loan markets, securitization markets, etc. So whatever product you take, the share of large corporates was incredibly high because the lending ecosystem had become very, very risk averse, right? And naturally, we've had multiple both political, man-made, and natural crises in the last 7 years, which had made the market very conservative, right? And as a result, we saw a huge opportunity. We saw a structural opportunity. We saw that if we could price the risk well and build a very strong moat on acquisition, right, we would actually be able to build a very robust balance sheet, right? And that's that. And I think it's played out that way in the last 6 years, both in terms of client coverage, deep-rooted sectoral coverage, geographic coverage. I think this has been a very rewarding market for us to work in. It has also allowed us to stay true to fundamentals, which is diversification, granularity, not taking interest rate risk, ensuring that the risk is priced in well, and therefore ensuring a fundamentally a good outcome from a P&L and balance sheet perspective. So yeah, I think no regrets. It's been a great 6 years.
Great. Vineet, you talked about the pricing. Parth has taken us through the times of COVID where there was a rise in the overall repo rate, but the similar was not passed on to the end customer. Only some of the cost was passed down. Some attendee has asked this question that the cost of borrowing has not increased much is a good thing for the company. But why is that yield also not increased in the increasing interest rate scenario? Are you not able to pass on the interest rate hike? If somebody is asking for the clarification.
Yeah. That's a great question, and we must note that that different parts of debt markets operate with different kinds of elasticity. What I mean by that is that a AAA company, right, or AAA bond, the yield keeps rising and falling with GSEC, right? But by the time you reach triple B, it is almost flat, right? And that's the nature of the market, right? Because the AAA and AA bonds are very, very sensitive to interest rate movements. So the yield is 50 to 100 basis points above GSEC, right? But the triple B market is largely flat because the liquidity is very low. There is no secondary market in triple B, right? So that is one way of looking at it, that the actual elasticity we see in pricing for AAA and triple B changes quite dramatically. A different way to see it is that a typical corporate or mid-corporate runs at a return on capital employed of anywhere between 18 to 25%. तो 18 से 25% का उनका ROCE है, right? If ROCE is 18 to 25, then how much can they pay for debt?
Correct.
Right? They can't pay 18% for debt if the ROCE is 18%. There's no point in borrowing, right? So there's a natural cap to how much of pricing can be absorbed by the mid-corporate space, right? Given the kind of ROCs we see in the market. Large corporates, the cost itself is 7-8%, they can move up and down. But the moment you have reached 14-15%, the room to move up and down is very low, right? For these two reasons, one is driven by supply, one is driven by demand. The pricing is relatively flat, irrespective of movement of rates. And that's why, as Parth must have mentioned, it was so important for us to control our cost of borrowing, right? Because beyond a point, we cannot increase lending rates in this market.
Because we fundamentally very well explained the dynamics of the bond market when you go down the curve. That's very well explained. But what do you think the role of the OBPs are, like the online bond platforms? I think they are trying to increase the acceptability and the required liquidity, not to an extent that the AAA enjoys. But what is your view in the role that the OBPs are playing to take these set of products to the end investor?
I think they're playing a great role in terms of increasing the share of the corporate bond space in HNI and individual balance sheets, right? I think fundamentally the risk in this market has been much misunderstood, right? And it is actually possible to create a high quality portfolio of such bonds and still be able to manage risk well, right? Now, the reason I say this is because we did a long-term study of 10-15 years of corporate bond markets, right? Of corporate ratings, right? India has a very rich rating database, right? In the last 10-15 years, more than 50,000 SMEs have been rated, right? And therefore, you have something called a transition of default data that says that if a company were triple B rated, what would the likelihood of default be for a portfolio of triple Bs, right? And the number might surprise people. That number is approximately 3.25%, right? Which is not very high. Correct. Because if you look at the spread you get on triple B over GSEC, you get approximately 7.5-8%.
That's huge.
So if you create a portfolio of triple Bs, theoretically, right, you should be able to realize a delta return of 7 to 8% over GSEC while suffering a loss rate of 3 to 3.5%. So you're significantly net positive from an adjusted return perspective, right? And this is coming out of public data, right? Now, and this is, by the way, if you're simply spraying and praying, right? If you're controlling portfolio quality and underwriting, etc., then the default rates can be lower, which is exactly what we have seen. Okay. As a company, right? Today we have a gross NPA of 0.3% and we're lending at 14%, 14 plus today, right? So fundamentally, I think it's a good market to be in. It's debatable whether how much of anybody's own personal portfolio can be allocated towards triple B. That's based on basis their risk appetite. But clearly, the online bond platforms are doing a good job in deepening the depth of the triple B and A-rated market.
Thanks, Vineet. Just we'll take few last questions, Vineet, for the interest of all the attendees. Some of them are asked that who are your major competitors, who are the major NBFCs operating in the mid-sector lending, and what is the specific competitive advantage that Vivriti has?
So we rarely see players who are spread across the product spectrum. Vivriti has taken a lot of care in the last 6 years to not just lend to mid corporates, but also be a multifaceted provider of products. So ranging from loans to working capital to bonds to commercial paper to securitization to vendor finance, dealer finance, factoring, leasing, etc. Right now, in different products, we find different competitors. Right. For example, on supply chain finance, which is vendor finance, dealer finance, factoring, we very often see Hero Finco. Right.
Okay.
If I'm lending to other NBFCs, I typically see Northern Arc or Mass Financial. Right. If I'm lending to corporates, we very frequently see Tata Capital. Right. Or let us say Arca FinCap. Right. So in different segments, we see different competitors, and frankly, not that many competitors. This is not a deeply competed market. Like if you look at a market like consumer lending, right, everybody will have 6 apps on their phone.
Correct.
Right. हमारा situation नहीं है.
Okay. Few of the last questions we need, I think, what expansion strategies, I think it is best to come from the horse's mouth himself. What are the expansion strategies are in place to broaden the outreach and connect the larger audience through the establishment of new branches? I think people want to understand, investor want to understand your expansion plan, the strategy going forward. How do you see the Vivriti story panning out?
Great question. So few things there. I think for expanding, there are two significant requirements for us. One is to broaden our outreach, which is essentially through through physical presence across the country, because we're in a mid corporate space. We don't acquire digitally; we acquire physically, right? And the second is liabilities, right? We want to ensure that we have a very large and diverse pool of access to money to ensure that we are always we always have our engines firing, right? Now, from a growth perspective, I think both are today looking quite good. We are present now in 9 locations across the country as we speak. Access to liabilities remains quite strong across banking, capital markets, ECBs, and different categories of the market. In terms of client addition, we've had a good run in the last 12 to 15 months. We add anywhere between 6 to 9 clients a month today into our franchise, new companies that are borrowing from us, right? We've also invested in areas like product development, infrastructure, technology, people, processes to make sure that we're able to grow going forward. And therefore, I'm fairly sure that I'm fairly confident of maintaining a strong growth trajectory over the next few quarters, right? I think the market also has a lot to offer, which is why we are quite bullish. Naturally, we proceed with caution because we want to make sure that we take the right calls. So there are sectors, for example, where we are not bullish, where we saw a massive growth surge during COVID, but now it is sputtering, right? Or wherever government policy is not supportive, again, we are significantly cautious in terms of proceeding. But by and large, we see a good macroeconomic situation for us to grow.
That's good. I think the future holds really bright for Vivriti as a company. I will just take last question and will ask it to Parth because this is regarding the public issue. Somebody has asked, is the issue is secured against the assets? What type of assets against which this issue is coming up with? Someone has asked to show some light on the issue structure of the public issue. Whether it is permissible, I leave it to you, Parth. What all things you can disclose about the upcoming public issue? You're on mute, Parth.
So this is a very friendly, investor-friendly structure by way of
Let's go full screen, Parth, just to make it clear.
Yeah. Right. So very so this Very investor-friendly structure. We have 5 strips. So we have monthly and annual paying coupon in the 18-month category. In the 24-month category, we have monthly and annual coupon option. And the option number 3 is a unique option where the investor gets the principal back in 8 quarters, 8 equal installments. Right. So 1,000 rupees is paid back in 125 rupees each in 8 quarters. Right. So wide range of interest also. So 998 ranging to going as high as 1049. This is the annualized YTM return on the bond. So this is the range on offer. The entire borrowing under this retail issue is secured by hypothecation over receivables of the company, right? And we have deliberately kept the issue tenor short. We have not gone long. This being the maiden issue by the company. So we'll come back to the market, but for the first time, so investors who want regular income can opt for monthly interest. Investors who don't want to take reinvestment risk can go for annual interest, and who want redemption, investors who want redemption on a very regular frequency can go for option number 3, which is quarterly principal and quarterly interest, right? So very issuer friendly structure per se.
I think it has been designed in a way keeping the understanding of the pulse of the retail people who would like
Yes.
to probably get a regular principal back. That's a good structure, I must appreciate. For the benefit of all the attendees, thefixedincome.com, which is a registered online bond platform with SEBI, is also hosting a link through which you can apply for these debt public issue. So would be happy to take any of the entries that comes in offline with your relevant relationship manager. The link would be there on the fixedincome.com website too. So whosoever would be interested, there's a lot many other queries too, Parth and Vineet, that are left out. I think we'll take it offline because the webinar is already stretched from the standard time of 30 to 40 minutes. But it's good to see that people are still participating their queries in the chat box, which is yet to be answered. We'll definitely answer those queries. We'll mail it across to the issuer, Vivriti, and we'll get the answers and reply to those queries separately. So, any point that Mr. Parth or Vineet you would like to do as a closing remarks?
Sure, I'll just take a minute because I think just to make sure that we're covering everything. There was a question on our repayment plan. I think it's important to note that Vivriti has always maintained a conservative liabilities and liquidity strategy. We are today subject to the liquidity norms of the RBI because we are a middle layer NBFC. So we are subject to LCR norms, and that is monitored on a high frequency basis by RBI. Secondly, we have in the last 12 quarters never had a month where our cumulative liquidity position was negative as per the ALM submitted to RBI. So we will. It is therefore our endeavor to ensure that we continue to maintain this level of liquidity in the balance sheet as per regulatory norms and possibly exceeding regulatory norms to make sure that the repayment of this issuance happens on time. Secondly, from a portfolio and credit risk perspective, as I mentioned, we've run a very tight book. India is a country where we get a wealth of digital data, be it on bank statements, GST, Bureau, Ministry of Corporate Affairs, Provident Fund, litigation, and a host of other areas, right, which allows us to triangulate a company's position, financial position, and commercial position, and tally that with what the company is telling us. We also conduct a very detailed 2-day in-person diligence. We run our own rating model, and we review ratings and company's position every quarter, right? And that's why we have been able to maintain a fairly tight portfolio outcome so far, right? In summary, I would like to say that the first time is always special, and that's why we have tried to make this issuance as friendly and as attractive as possible. And really hope to see many of you and your clients participate in this issuance, and I'm sure it will go well, and I'm sure we'll be back with many more as well.
Sure, Vineet. That was an enlightening webinar for us to get insights of the Vivriti business model. I'm hopeful these insights would be considered. So people who have attended the webinar are not only the investors, they are people probably going to speak about the issue going forward. So wish you best of luck, Vineet and Parth, and we too are hopeful that you will get the desired success in the public issue. Thanks a lot for your time.
Right. Thank
Thanks,
you.
Nagesh. Thanks, everyone.
Thanks, Nagesh.